Welcome viewers to a very special edition of the Forbes India pre-budget discussion. We have three eminent speakers here with us who will try and delve into some of the biggest problems that the government needs to look at and will be facing in the upcoming budget. Really, the critical element is in the post-pandemic period, what is the government most likely to do? Will they walk? How will they walk the tightrope on managing fiscal deficit, which continues to rise, and try and revive growth, pick those animal spirits up to continue with the buoyancy that we have seen in the previous quarters. So I have here with me three eminent speakers. I have Manish Sonthalia, who heads PMS at Motilal Oswal Securities. Hi, Manish. I have
Hi, Salil.
Dipti Deshpande, a senior economist with CRISIL. Welcome, Dipti. And
Thank you.
Siddharth Shah from Khaitan and Company, a senior partner at Khaitan and Company, who will delve into critical tax-related issues. Welcome all of you. I'll throw it open to all of you first. Uh, what do you think is the direction the government needs to take right now? We've seen uh, we've seen some amount of buoyancy creep back after the unlocking of the economy, especially in Q2 and Q3. But what do you think are those critical elements that they need to address immediately? It's open to the floor, Manish or Dipti or Siddharth.
Dipti, you can go first.
Sure. Yeah. Thank you. Hello, everybody. I think it's a very pertinent way to look at, what the government is going to do at this juncture because a lot of unexpected moves have been taken in the last couple of months. So I think overall, if you go to see the way I'm wanting to look at this budget, is a budget that would want to, support this nascent recovery. A large part of what was done last year was essentially damage control in nature, trying to protect and support those that were most vulnerable, most risk, etc. And now, in the last couple of months, we are seeing some sort of recovery, as you said, Salil, seep in. So it's absolutely essential to support those quarters of the economy. So it's going to be largely supporting recovery that we'd see here. Now, given that fiscal room is limited, it cannot be a big bang, stimulus that we see, but it'll have to be a mix of monetary and non-monetary measures that are undertaken with definitely a keen eye on the medium term, because that is one path that we've somewhat gotten derailed from. So we'll need to chalk out some way of getting back to that medium term growth path. So I think this budget has a lot to do from those as all of these aspects.
Right.
Sure.
Manish?
Yeah, so after the 7.5% contraction in GDP that you'll be seeing for FY21, I think for FY22, one is looking at a 10% real GDP growth and something like a 15% nominal GDP growth. Obviously, in the backdrop, what we are seeing is a V-shaped sort of a recovery as far as corporate numbers are concerned. Some say it is a K-shaped recovery because part of the unorganized sector has actually fallen by the wayside. It gives more leg room to the organized space, and that is basically manifesting itself in the numbers. I think the roadmap before the government is to just keep the momentum going. Of course, as Dipti said, the fiscal leeway is less. You are looking at 7.5% sort of a fiscal deficit this year. Obviously, next year is going to be anywhere between 5.5%, 6%, if my numbers tell me that. And from that point of view, I think the basic need of the government is to spur investment. The leeway again from the budget point of view is that tax revenue this time around for fiscal 22 is going to be strong because 10-15% nominal GDP growth should mean that taxes should be increasing by 19-20%. And obviously, apart from the expenditure on defense, railways, roads, etc., we need to see some sort of increased expenditure from the government side so as to just keep the momentum going. Apart from that, impetus on job creation, etc., would mean that FY23 roadmap for a GDP growth of around 5.5-6%, that would be really the normalization of the entire way. What we had seen before the pandemic, from 6% it fell to 4, and then minus 7.5, going up to 10, and then normalizing at 5.5-6%. So I think spurring investment, job growth, incrementally supporting, vaccination all along so that we come out of this pandemic in a good way without too much of disruption.
Right. Siddharth?
Yep. So I think again, this probably is going to be the budget which would really be testing the mettle of the policymakers. I mean, on one hand, you have a very little fiscal room, and then I think we do hope the V-shaped recovery kind of and then the increased tax revenue potentially might give them some leeway for the coming year. But really, with the limited fiscal room, I think the focus of the current budget is more likely to be structural reforms, because that's one area where I think how you encourage foreign investments participation, remove whatever are the roadblocks, because I think from a high impact perspective, I think those changes which can kind of increase the momentum in terms of increase the investments coming in, I think that will remain a very primary focus for the government. At the same time, I think the government needs to strike a balance, because I think obviously the expectation is that there will be an additional tax. People talking about cess, and I think we can come to all of that later. But within that, I think how do you really balance out? I mean, you've just about unleashed the animal spirits, which we've been talking about. And I think we've started seeing that momentum kind of really build up. You don't want to be a dampener by putting in any additional tax costs or otherwise. And how do you then balance it? I think that's going to be the trick. And we really need to see how the policymakers really make up for kind of finding a bridge between these two. So I think that's really going to be an important.
Right. So Dipti, you'd spoken about the thing of supporting recovery. Should they at the moment think less about the fiscal deficit numbers, just looking at a number as a figure, and should they alongside just simply focus on reviving growth, try and ensure that people can spend more, the consumer spending power, which even Manish spoke about?
So I don't necessarily think pushing fiscal deficit too much would be a good idea, because we are not just pushing that. I think the debt for our country is also ballooning, and the eventual worry is basically how to bring down that debt. After all, we can't just go about taxing up. Per capita incomes are low. We can't raise taxes and bring that down eventually, just the way advanced economies are in a position to do that. So I think there will definitely be a keen eye on how much fiscal deficit is being stretched. But I think there are a number of anomalies that got created in the economy in the last fiscal, and Manish hinted towards that. So where the K-shaped recovery is essentially coming in from. So, for instance, if you look at sector level data, what that shows you is that perhaps services was hit a lot more harder than manufacturing. Simply put, manufacturing fell by about 9%, but if you look at contact based services like trade, hotels, that segment, that came down by about 21%. Now that's a worry, because sectors like these, they are large employers. It's that sector is in fact the biggest employer after agriculture. So you need to have some mechanism in place to remove that anomaly, wherein manufacturing got some sort of a support, but services didn't. Similarly, if you look at the small versus large agreement, if you look at even a recent CRISIL study that was done, it went to show how smaller firms were hit more dramatically by the COVID-19 pandemic hit than larger firms, merely because things like they typically have weak bargaining powers, face liquidity issues, their reliance on capital is relatively more unorganized in nature, things like that. So if there can be more support factors that come in for these smaller firms and micro enterprises, etc., I think these are the way to go in. So it's not necessarily, I'd say, monetary measures which expand the deficit, but also encouraging more support that can come into some of these segments of the economy through through others who wanting to fund in some ways or wanting to support. So I think it will clearly have to be a mix. We are unfortunately not where we were in FY09, where we did have a large amount of fiscal room and we could go out and spend. I think thinking on the fiscal targets is absolutely essential. So I think that's one of the biggest, yeah,
Right,
sorry.
right.
Mm.
Dipti, if we had to do a report card of how the finance minister Sitharaman fared on the credit guarantee schemes for the MSMEs, if you had to look back on really that, how would you rate it now? Has it solved most of their problems? How bad is it on the ground?
See, overall, I don't really have much of an understanding whether it's reached the last mile. But if you just merely look at macro data that's available, it goes to tell me that large parts of the unorganized segments of the economy didn't seem to have done so well in Q1 or Q2 or even H2 for that matter. They are still lagging. So it does mean that the better off guys, the larger firms did get, maybe the larger MSMEs did get some handle on it. But perhaps, like we all know, funding doesn't quite reach the smallest or the most unorganized parts. So I think they would still remain out of the ambit of the government to a large extent. But I think having said that, there are some other quarters of the economy which did get some support. So if you look at rural versus urban for that matter, most of the programs were aimed or focused towards supporting the rural areas. And if you see, incomes there seem to be doing better. They seem to be having a better purchasing power than the urban folks here. So I think it was a mix, but some segments have fared well. The others, maybe it was not really intended to reach the entire segment as a whole.
Right. Manish, what's your assessment of really corporate earnings now in Q3, the numbers that we are starting to see? Do you think it would sustain?
Yeah, in fact, Salil, I think the numbers are positively surprising, whatever numbers have been coming. And this is across the spectrum. So if you talk about technology, some of the sectors which are really firing on all cylinders, technology, because of the slowdown, corporates are using technology to boost their growth. Of course, digital is an important piece within that, and companies all over the world are taking advantage of the outsourcing opportunity out of India. Technology is seeing that sort of a growth. Another thing which is very pertinent this quarter is the PLI related incentive which corporates want to reach out for. See, this could be a game changer policy as far as India is concerned. And this sort of a policy is what triggered manufacturing out of China. You know, previously we used to have the MEIS scheme, the Merchant Export Incentive Scheme. 6% was used to be paid as incentive to corporates, and it was available to everybody who exported. The PLI scheme is offered out to specific sectors. I mean, currently we are seeing the white goods space actually benefit significantly out of it. It is available for corporates who can export more than 1,000 crores. So channelizing your incentives to a few large corporates which can really scale up, and that is the way to go. And today, every corporate in every sector is talking about doing some sort of a business outside India and take advantage of the PLIs.
Hmm.
You have large corporates like Havells talk about lighting exports out of India, or let's say air conditioners exports out of India. Very soon you'll have the apparel manufacturers who are large exporters out of India come. So net within the corporate space, numbers are pretty good. FY22 is looking like a 35-40% sort of an earnings growth for the entire corporate space as a whole. And on top of that, if we have the impetus of growth coming through with the room available for few players, because large segment of the corporates would have gone out, especially the MSME space, the field is available for lesser corporates, so the profit share is going to be shared within a lesser number of. So market share taking away, PLI incentive scheme, digital adoption, and private sector banking gaining at the expense of public sector. These are the broad themes. Currently, the corporates are positively surprising, and next year is looking like a 40% plus earnings growth, and FY23 currently is looking like a 25% growth on top of 40% growth. And this is all due to, of course, the lower corporate tax rate, but also the savings which have come through, not only from the employee cost, but even the electricity and all the overheads which have come down. And some of these costs are now permanently restructured on the downside.
Hmm.
If the growth comes, you will see a higher operating leverage. That is what is manifesting itself in higher growth numbers that we are seeing for corporate. This quarter should continue even in the fourth quarter and going into FY22 and beyond.
So would there be more PLI incentives this time too? Would they want to
Yeah,
broaden it out?
yeah, of course. So we are hearing nitty-gritties on the autocom space, the auto OE space. We are already seeing the white goods, the consumer durable. Some of the segments have it. We're already hearing manufacturers in the steel and the cement, not steel, cement, but steel, talking about taking advantage of PLI schemes to expand capacity if the incentives were to come through. So this could be a way in which the private sector capex, which has been in a limbo for a reasonable amount of time in India, just get kick-started.
Right, right. So that uh, it's always a sensitive part when we look at taxes, and each year that whole momentum builds up, partly with the media, partly with public commentary on what the government should do relating to tax. It's precarious this time. I mean, how much can they really think around with? Uh, you don't want a scenario where there are tax ops and then they are unable to, they need to roll them back or things like that. Um, what is it that they should do?
So I think, as my opening remarks said, my sense is the fiscal room for them is very limited for any tax sops this year. I mean, while one may expect a lot of incentives to kind of as a compensation for the suffering, so to say, of the last year, I really don't think the government today would have any fiscal room to kind of offer on that. And also talking about tax rates for corporates, I think we are in a very competitive tax rate stage. I mean, gone are the days where we were talking about 30, 35%. I think with the corporate tax rate already kind of brought down to a 20, 22%, I think it's something which honestly cannot be expected anything more. Where I think we might see some incentives, so to say, would be investment linked incentives. And I think that's really where the government is likely to focus a lot more. And this would include sector specific. So very clearly infra is one segment where you may see they've already kind of offered tax incentive for large pension investors, sovereign funds and others. I think the government may look to kind of further extend it in terms of, because they had sunset clauses coming up in 2024, and with this 1 year completely washed out, you might see them extending eligible projects for those incentives to really, so they may kind of tinker around with those provisions. Second, I think today, if you really look at it, and I think suddenly the private equity and venture capital is an industry which seems to have come of age, and suddenly the government's realizing the huge potential that they bring in. And I think by some numbers, published number, almost 70% of the total FDI this year is triggered by private equity or venture capital. So there are obviously industry demands over there in terms of tax parity between listed and unlisted securities for AIFs. I mean, I think that's one demand which seems to be on the top of the agenda for the industry. And there's strong logical reason for them to say that when the industry is kind of willing to take higher risk with illiquid, unlisted securities and yet be subjected to a higher tax rate of 20-22% from a long-term perspective as compared to listed securities with 10%. I think that could be something that the government would consider, because I think, and again, not in general, but for a specific class of investors, because they are essentially contributing constructively to investments, employment generation, and long-term tax contribution to that extent. So those are some of the incentives that we might look. I mean, there are challenges with this whole angel tax, which we had seen, and I think every year the government seems to be kicking the ball down the street with some change or otherwise, but never fully resolving the problem. I think this is the time where obviously the government can come out more boldly and effectively spell out that an angel tax, which was otherwise meant to be an anti-abuse, those where it was meant for and where it was introduced were never intended to cover startups where they are raising capital from a willing investor at a higher value. Why should they be subjected to tax and put through a lot of? So that I think is going to be it's going to be very kind of precise, sector specific, investor specific incentives that may come through rather than a broad brush changes in the tax.
Right. Would that some of the experts we were speaking to were talking about this, a possible pandemic cess, and I'll open this is open for Manish and for Dipti also to comment on. They all were saying, look, if a pandemic type of cess comes, it's really bad. Now, one of the arguments given is that the government may introduce it for everybody, but a small token amount for this year, and then do away with it in the next budget. But how bad is that? Because a lot of people said, look, this is the worst time to try and tax people a little more. What do you think?
So, at least my personal view out here seems to be that most segments, I mean, I'm saying maybe not a general cess for everyone, but I think cess seems to be on the cards, and more likely than not that you will see that coming through. How you really kind of ensure that you are not burdening the so-called already burdened with more cess. I think that will be the leeway or the room play that they will have, whether they link it back to the same. And they've already set the ground, if you look at it in the last couple of years, the concept of a super rich and then basically making tax incentive. And that's probably how they might look at it. And then in terms of bringing that up for a certain segment of the super rich, and where you might see an incremental tax, may not be something that maybe get extended across the entire tax base to that extent. But more likely than not is what this is something we would see. The only worry I think with cess and in India is once they are introduced, they continue for good. So, and I think that's one area where obviously me as a taxpayer or anyone else, we are already, if you look at even that segment of super rich, we are already inching closer to a 42% tax. And with every additional cess, we are going back into a very high tax regime, which at some level will start kind of disincentivizing capitalism in terms of many sense. So while we've done enough to bring back the reverse brain drain, a lot of people have come back with the idea of a more moderate tax regime and all of it. I think some of these with more mobile kind of industries like a fund management or whatever, where it's easy, if the tax rates kind of start becoming more and more unattractive, I think you might see that. And so I guess they'll need to find a balance in some form and then ensure that it is a very specific purpose for a specific period and to serve. I don't think most would mind that, in my view.
Okay. Manish, a tax cess on this, how would the markets or investors look at it?
See, tax rates for the rich are already very high, and there's a lot of cribbing happening in the richest sections of the society, given the rates of tax that we are in. There's no question of any personal income tax rates going down. As Siddharth was mentioning, that you could have a COVID cess come on the super rich, so 37.5% could go up to 40, or the highest income tax bracket could go up to 42, 43%. So that is very much possible. I think corporate rates are not going to be touched. Where the tinkering can happen is basically on the indirect tax. A lot of import duties could be increased, and that is how I think the government, because excise and customs duty or import duties is where you can just have some sort of a leeway. Direct taxes, you really don't have too much of leeway. There is going to be a significant amount of buoyancy as far as the total tax collection, but I think they will tinker around with excise duties and import duties. And doing away with black money, etc. Those are part, of course. I think the government is going to be even stricter on purchase of jewelry and the cash transactions, etc. So these are some of the areas where I think some tinkering on taxes, but by and large, budgets really gone are those days when budgets used to be all about taxes.
Mhm.
It's it's
That's
now become oblivious of the budget per se, as I think.
You see a deeper market correction, Manish, if the cess and comes.
No, I don't think it is going to have too much of an impact if the roadmap for the fiscal deficit, the growth numbers, if they seem plausible, and if the markets are satisfied that the government is trying to increase expenditure, which will mean that normalized GDP growth of 5 to 6% is par the course. They'll shrug off the taxes if that was to come through. Any increase in import duties, etc., would only be protectionist from the domestic business point of view, and that should be liked by the market.
Right. Dipti, so taking that same route, indirect tax, rise in that, maybe a cess. How will they tackle the other biggest problem, disinvestment? Because we have again missed the target last year, but that would be the third element in which they would be able to get growth. Get revenues.
Absolutely. Yeah, I think, echoing what Manish and Siddharth were essentially saying, I think the cess, if at all, if I can start with that part, will have to be very delicately balanced, because it's not just for the Indian economy. It's not just FY21 that saw a growth slide. Essentially, we started growth slipping, especially consumer demand. So we saw growth slipping a couple of quarters before FY21, and consumer demand was essentially slipping. We had incomes coming down. We had sectors that were getting hit, which were extremely employment intensive, be it auto, construction, exports, etc. So I think the Indian consumer was essentially waiting and watching in FY20 whether the future is going to be better, and therefore not spending as much. And then we had FY21. So in Q3, etc., whatever spending that we are seeing is happening on the back that, you're probably a little bit of pent up demand, a little bit of expenditure reorientation from, because I can't travel abroad as much, let me buy some, consumer durables, etc. So when this little shift is happening and some bit of purchasing power is there, having a significant cess on that segment of the economy which is actually consuming can be a bit detrimental to keep the momentum going. So I think that will have to be very delicately planned. In terms of disinvestment, while I do agree this could be yet another year where we could have, a fairly high disinvestment estimates, just like we've had in the last 2 years. But if you go to see the next year, we are expecting, CRISIL itself is expecting a 10% GDP growth number, of which the first half is expected to look somewhat better than the second half. The first half is also going to be characterized by better global growth. So overall, it's going to look good. So if we do have a relatively large disinvestment program, I think it's time to front load it and see that the timing is right. Because typically, if you see in the last 2 years, disinvestment has gotten pushed towards the latter part of the year. And then when you can't really garner as much as you'd like to. So we'll have to be very careful with the disinvestment, etc., to really make it work.
Manish, one of the critical elements which both Dipti and Siddharth spoke about is steps the government should take to revive growth. If we look at the private sector, and that responsibility now will be towards the private sector to revive growth, are you seeing any green shoots at the moment on
So,
private capex?
in the past, there have been many such calls that green shoots in the private capex was happening, but it never came through. But this time around, I think of the four things required for a capex to begin, first is the profitability in that sector. So broadly, you're seeing that profitability in the entire corporate space is going up. Second is your benign interest rate environment. So the cost of money is primarily being lower than what it was before. Third is that there is a shift from the unorganized to the organized, and the pandemic has only helped that. You have many players which are no longer relevant and have just shut down shop. So the guys who survive have a bigger pie to take the share from. And the fourth is that the government is pushing through PLI and other schemes. So this time around, I think a little help and the private sector capex, which has been really very lean for the last 5 years or 10 years. Ever since the global financial crisis, we really haven't seen the private sector capex. And our growth was actually coming from consumption rather than investment. This time around, I think if the growth comes back on the back of investment, we would be entering a virtuous cycle and all the ingredients are in place. So it's early to take a call whether green shoots are there, but definitely corporates are talking about, thanks to the recent push from the government on the PLI stuff.
Okay. Okay. Dipti, will you will this growth sustain? What is your assessment now? If based on, of course, what Manish had been talking about, we are seeing encouraging corporate earnings, and assuming that the technical, recession will be out of that at some point in mid 2021. But looking at agriculture, looking at services has picked up. Do you expect the growth to sustain? What are your numbers that you're forecasting for FY22?
See, for FY22, we are expecting GDP growth at 10%. But even that 10%, I'd say, is more optical in nature. One is because we have a very weak base. Second is there is a tide effect that's coming in from global economies, because global economies themselves are expected to see some sort of a growth spurt. So if you look at the level of GDP in terms of a level, we are just going to be somewhere around FY20. So to that extent, we have about 2 years gone. So we've done some calculations and we've tried to look at what is the permanent loss that the economy is facing just because we had this setback in FY21. And if you look at that permanent loss, it comes to somewhere around 12 or 13% for a matter of about 2 to 3 years. So to also give you some other kind of an understanding, our medium term outlook for growth was initially somewhere around 6.7 to 6.8%. Now we are expecting that to be somewhere around 6.2 or 6.3%. So FY21 is definitely one reason why that is happening. The second is also, even as we step into FY22, we are going to see sectors like manufacturing, etc., catch up at a faster pace. But we are also expecting contact-based services like contact-based sectors like services to lag. They will take some time to really come back. So I think these features will play their role even going into the medium term. So after 10%, we are expecting to see growth, drop down, but to see it relatively more stable. And I think similar to what Manish is saying, the stability in growth or the steadiness in growth also comes in. Moderate expectations also come in because it's not expected to see a very consumption-driven growth even in the next 2 to 3 years. So investments will have to play some role going forward, and I think it will have to come first from the government's side. Even if the government doesn't come in a big way to spend, it will have to chart out some sort of a roadmap for the next 2 to 3 years, that we have these kind of investments in mind, how we are going to take them forward, what kind of participation we'd like from the private sector or from the foreign capital, etc. I think all of these indications will be necessary to ensure that there is reduced risk aversion, there is more appetite to come and spend, etc. So I think that will have to be one way of bringing in a private sector and channelizing the investment drive.
Siddharth, and I'll bring Manish and Dipti into it also. Siddharth, one of the arguments given is that the government will, they've tried to refrain from bailing out, some specific sectors which are really ailing, like your aviation and hospitality, tourism. But they might introduce some tax ops for the construction real estate sector. Do you see that happening because of the position it occupies in the economy?
So I think, yes, they might take a more sectoral view of these changes, tax changes, as I said, and then maybe real estate is one strong indicator. And in some sense, if you really look at some of the states, even with a small incentive on the stamp duty side, I think has really spurred, at least in the urban market. I mean, I think obviously, so in a way that gives confidence that maybe some of those tax, both direct, indirect tax incentives, I think can go a long way in terms of spurring growth in sectors like real estate. Similarly, I think bringing in more institutional capital into that space, again, going back to a point that Dipti was making, I think we've started seeing the success of products like REITs, InvITs. And I think for some of them, I think this will obviously go a long way in terms of creating incentive for global investors to also kind of come in with products. And if the yield kind of starts looking better, and it's been surprising how the yields have sustained even through the lockdown for most of them. And a little bit of incentive to a sector like that can go a long way in terms of bringing in capital as well to spur that growth. And similarly, I think aviation, I guess they will need to look at it. Both travel, tourism, aviation are sectors which obviously have had a substantial hit. And I think they'll need a lot more hand-holding in a way from the government. So I think maybe even a short-term incentives for these sectors to kind of really come out, whether it's in terms of any GST or any of the other direct or indirect tax incentive that can kind of help them tide over the liquidity and other situations, I think will go a long way. And I would think they should feature on the government list to that extent.
I'll come to the third element of our discussion, which is trying to understand really what is the biggest challenge the government faces. Open to all, whoever wants to start on. What is the biggest challenge, and how do you think they can address it over the next 2 years, if not this budget?
I think the biggest challenge for the government is to meet the disinvestment target. It has been such a no-show over the last many years that the faith on the disinvestment number, the non-tax revenue portion of the budget, is really looked at very skeptically. So whether it be the telecom spectrum auction numbers or the disinvestment figures, I mean, just swings the needle within faith and no faith for the budget maths that comes about. So I think the proof of the pie will be in actually executing the disinvestment numbers and improving the productivity of the public sector units per se. You know, the government has talked about enforcing key matrices which will actually augment the shareholder value, because today we see that there are virtually no takers for the government paper, especially the equity paper, when it comes to offloading of the shares, and that is why they find it so difficult to meet the disinvestment target. The second is basically, you know, broadening the debt market. I mean, time and again we have talked about it, but really it has not yet been such a great show so far. So for me, these would be the two main areas where, you know, some work needs to be done to improve the credibility.
Dipti?
That's right.
I think given the fact that they have very little resources at hand, including the aspect on this investments that Manish mentioned, how to really bring back the investment momentum. Because if you look at infra investments per se, it is still the government which plays the bigger role. And if you go to see, at least in the last 3 to 4 years, it's not central but also state governments which are playing a much bigger role in terms of funding infrastructure. And now, as we see it and as we know it, it's the state governments which have been hit harder. So how do they really come back and support investments is going to be big. So the story with consumption has been played in the last couple of years. It's now time for investments to see some sort of a comeback, and that's going to be the biggest challenge, given that you have a huge debt burden which you would have to gradually wind down, plus you will have to make way for these other imperatives. Plus, of course, there's healthcare which will need spending at least in the next 2 years. Yeah.
Right. Siddharth?
Yeah. So I think just to add to what both Manish and Dipti said, I think first big challenge that I see the government, and then again over the years, building or capitalizing on that investor confidence. And I think that's one area. While today we think we sit in a very sweet spot from a global investor community, I think when you're policy making or formulating your, whether it's tax policy or otherwise, you got to be mindful that the world is going to be competing with us. I think gone are the days, and I think most economies, as we've seen, are going to bounce back, and maybe at different points in time. I think sometimes that the bureaucratic supremacy that sets in, that we are the most coveted destination for global investor, and then that arrogance, I think that's one area that the government really needs to kind of be focused on to make sure, and that translates into tax certainty, because in spite of no retrospective tax and a lot of those promises, if you really go on the ground and you really talk to MNCs and others, they still feel India is a high tax risk jurisdiction. And I think that's one area where the government really needs to work hard. And second, I think we are all getting very encouraged about manufacturing in India. But what's happening is today we are still seeing this. We are more assembling in India than manufacturing in India. And hence, I think we really need to make sure that we are there for the entire value chain, rather than just be an economy where we'll incentivize people to come up, set up plants only for assembling and selling, because we may lose out, and we have a huge potential there. So I think on that aspect, I think the government really needs to kind of, with this whole startup, ensuring that guys are incentivized to really go into more value creation activities, is really one of the areas that the government would need to focus on. Okay. So I think that's...
So to come to the last element of it is trying to understand that what do you think the government is most likely to do in terms of tackling the toughest problem, which is actually unemployment? How will they actually deal with that? Because each year we find that this, it gets kind of buried under the entire system of infra and healthcare and various mega projects being launched, but a lot of them don't really come about into, they don't fructify. So if you have India to grow at even 5% into FY22, 6% going ahead, how will they deal with the job part of it? Anyway, yeah.
Maybe I'll probably just go with what I think, and this is an issue that has been talked about, but obviously not tackled to the level, because I think the skill development and a lot of investment which has obviously been made in reskilling labor, skill development, and creating employable workforce. I think the results are yet to be seen. And I think while a lot of noise has been created, I think we do see that there's a lot more that needs to be done. On the positive side, I think with the pandemic and with some of those situations, extraordinary situations, my sense is the pull, or if you may call it a push, for people to reskill themselves has suddenly kind of come about. It's not the government only, but I think with the migrant workforce, again, a lot of that which has moved back, I think a lot of them are actually going out and reskilling themselves for whether it's triggered by loss of employment in the original. So I think that in some sense will provide kind of a momentum for the government. And if they can build on that, in many sense, combined with infrastructure development, combined with private capex push, I think it may not be as alarming a situation as it may look today. I think we've got the right ingredients. I think maybe a little bit of direction on that, I think, should kind of push us through to capitalize on that.
Dipti?
I really think that, from an unemployment perspective, if you look at the numbers, we are already at the pre-COVID level, some 9% or something. This is not because the employment numbers per se has improved, but the base has shifted lower. The working workforce has moved lower. The workable population has moved away from being really employable. They don't want to be in the workforce. The denominator has shifted lower, and that is why the unemployment numbers look quite good. And I think unemployment is a long-term problem. Really, it needs to be with how employable the people are, or let's say what sort of a disguised unemployment that we have in the rural sector, or what the labor reforms that are being talked about to be placed in the parliament has to say regarding contract employment, so on and so forth. So really not too much of a short fix problem that we can deal with, but it's really to do with what we can achieve in the long term.
Right. Dipti?
I think the way to look at it is essentially by looking at which are those sectors which have the ability to employ more people as they grow. So I think one of the typical sectors that we're all aware of is, okay, I'm not going to talk about agriculture, they perhaps have more than they need, but there's manufacturing that's spoken of and construction. But even if you keep aside manufacturing and construction, which by the way are not able to now employ as much as earlier with all the mechanization etc coming in, there are a couple of other sectors where mechanization will not play, or automation will not play such a huge role in the coming months, coming years at least. So one for instance is, you have a trade, retail, wholesale trade that employs a large amount of people. You have education, you have healthcare, there is food processing within manufacturing. Many of these are by themselves, they have very large how we say employment intensities. So it's possible for these sectors to grow, and as these sectors grow they can employ a lot more in the coming years. So what we've been talking about in the last couple of years is to identify some such sectors. It's just a list of about five or six, and then give a constructed concrete policy push to these sectors. Because even typically if you go to see, these sectors are not prone to as many fluctuations and volatilities just like a construction or manufacturing sector would be. So I think that is number one, identifying sectors with huge employment intensities and push them, to grow over the next 2 to 3 years. The other thing is that, when we saw this so-called high growth phase for India, that is in 2000s, we saw a very large amount of population essentially come out of the labor force. They were there, they were as a part of the working age population, but not willing to work because of a variety of reasons. Maybe, single household income that was enough and didn't really needed to come back. So I think there is a need for a larger amount of people to come back into the labor force, women especially to come into the labor force, compared to, we put out one or two articles maybe a couple of years back which said that if you merely compare India with a couple of other economies, the women workforce participation rates are terribly low, and these need to come in. Now, just pushing them to work is not going to be the case. There need to be jobs out there. So, like I said, an approach where you look at sectors, push them, and gradually get, the others to come into the labor force will should work well for India. And this is not really for the next 5 years; it's for the next 5, 10, 15 years to see to it that we have a steady and strong growth.
Right, right. To sum up, once again, we are seeing a scenario where some things are going to be very short term, and there could be some nasty surprises, as Siddharth spoke about, if that pandemic cess comes. But there are some positives, as Manish spoke about. We are seeing those green shoots. We're seeing private capex. We're seeing a movement there. And we can hope that some of the challenges that Dipti you spoke about in terms of meeting the disinvestment target, or actually just ensuring that you support growth. We can hope that all of this can be put together in at least, if not a part one in this budget, and maybe take it forward into FY23. We can hope that the finance minister, Madam Sitharaman, can tackle all of that. We look forward to to the budget, and hope that all of you could join us at some point at that point, and we could take this whole discussion forward. We also request our viewers to log in. We have two more special guests during the course of the week for our podcast, and where we will discuss similar events. So thank you, Manish, thank you, Dipti, thank you, Siddharth, for joining us for a very engaging talk. And best of luck. Thank you.
Thank you.
Thank you.
Thank you, everybody. Bye.
Thank you.